If you've got money tied up in an apartment syndication right now, and you're starting to see signs of trouble, maybe distributions have stopped, maybe you got a request for a capital call, maybe you noticed the sponsor is raising money for an opportunity fund. I have to tell you, unfortunately, you're not alone. It's happening across the country to thousands of investors right now. $104 billion in apartment loans came due last year. This year, that number is $162 billion. Let me put that into perspective because a number like that doesn't mean much until you can actually picture it. Take a building with somewhere around 100 to 150 doors, which is pretty typical for an apartment building. The loan on a property like this runs about 15 to 20 million. So 162 billion represents somewhere between 8,000 and 11,000 apartment buildings, all trying to refinance at the same time. That's over 1 million apartment units, 1 million homes with families living in them, all across the US. To get through this many loans in a year, the banking system has to process somewhere between 20 and 30 of them every single day for an entire year. So how do we get here? What happened that we have this many loans at risk of default? I think the investors who are currently in trouble with their properties assumed rates would stay relatively stable. They got the cheapest loans, short-term, instead of the more expensive 7 to 10-year loans. They didn't anticipate that rates would go up so high so quickly. So when those loans came due, starting in 2024, they couldn't afford the payments anymore. That's what's happening with 162 billion in loans due this year. Either the bank forecloses on the property, or the borrower has to pay down the loan significantly just to extend or refinance. And it's probably going to get worse before it gets better. Rates coming down significantly would help, but if that doesn't happen, more of these owners are going to have to sell at a loss, bring in outside money, or hand the property back to the bank. And if you've got money in one of these deals, unfortunately, there's a real chance that you see some or all of it disappear. And I want to be clear, this isn't hypothetical. I've seen a real example from earlier this year. An operator posted that he was doing everything right. Rents up 30%, occupancy above 95%. He still lost millions of dollars of investor money. Not because the property was bad, but because of two decisions made going in. They paid a price that only worked if rates stayed low, and they refinanced it with floating rate debt that came due before the market gave them room to refinance. It's not just bad operators running bad deals who get caught. It's good operators running good deals who made the wrong assumption. So if you're feeling like swearing off real estate completely right now, telling yourself you'll never invest in one of these deals again, I don't think you should give up on real estate. I don't think that's the right call. Just hear me out. Mistakes happen. I made one too a long time ago. Back in the early 2000s, I was buying land. These were lots with nothing on them in big developments around places like Sarasota and Destin, Florida. Back then, it was really easy to get loans, even if you didn't have income, even if you had a lot of other loans. Lenders didn't care. They just wanted to do more loans. It was just like the movie The Big Short, where the lenders are bragging about how many loans they're doing every month. Back then, everyone was doing 2 or 3 year adjustable rate mortgages, or ARMs. The rates on these were a lot lower than on longer term loans, which is what made them so attractive. You could even get these loans with no money down. And the assumption so many investors made back then was that real estate prices would keep going up and that you'd always be able to refinance into another low rate ARM. But when 2008 hit, that's when the music stopped and everyone got caught. Anybody with a short-term ARM couldn't refinance when those loans came due because the prices plummeted. So the story is a little different, but the lesson for me was the same. Avoid shorter-term loans and get longer-term loans instead. And I paid for that mistake. I never got foreclosed on. I never did a short sale. I never walked away from a single property. What I did instead was go to my lenders and restructure. Harder terms, but a path forward instead of a balloon payment I couldn't make. What did I do then? I picked up extra shifts as a hospitalist. Some months I'd work 26 out of 30 days just to service it all. I held on to that land for 13 years and finally sold it in 2018 at a loss. I had to bring money to the closing table just to be done with it. But I'll tell you what I didn't do. I didn't quit real estate. Real estate wasn't the problem. The problem was bad decision making on my part. A whole generation of investors made the opposite choice. They walked away from real estate for good. Instead of learning from their mistakes and applying those lessons to their next investment, they just got out of the game. Learning from your mistakes means making a different decision the next time. And that's exactly why when Leti and I started investing together in 2015, we both agreed that the way to protect ourselves was to get longer term debt. And it's exactly why through 2020 and 2021, while a lot of investors were locking in the same kind of short-term loans that caused all the trouble back in 2008, we were locking in mostly long-term loans instead. Not because we're smarter than anyone else, not because we've got some system that can't fail. We can still get something wrong. Anyone still doing this can. But here's what I can tell you. When you don't quit and you learn, you can get back faster than you might think. It took Leti and I 3 years to get to financial freedom, and we built on top of my experience from 2008. If you quit, you'll never have that chance. Nobody predicted how fast that 2008 crash hit. I certainly didn't. And nobody predicted how fast and how far rates would rise this cycle either, including me. The goal was never to predict the future correctly. Nobody can do that, no matter how many years they've been doing this. The goal is to build something that survives you being wrong. Mistakes are speed bumps on your journey. They don't stop you unless you choose to let them stop you. You hit one, you slow down, it jolts you, and then you keep driving. The only way it actually stops you is if you decide to pull over for good. Real estate isn't bad. It still comes with amazing tax advantages nothing else has. So let's look at the other side of it. You think pulling money out of real estate is the right answer? And do what? Move it into stocks? That doesn't avoid risk. It just moves it. Stocks can drop hard too. There have been entire decades where stocks basically went nowhere. You'll hear this from the ultra wealthy. You need to diversify. Real estate is one of the best ways to do it. But don't put all your eggs in one basket, whether that basket is stocks or real estate. That's true whether you're still building wealth or whether you're ready to start protecting what you've already got. Either way, don't quit. Learn instead. Now, if you're ready to diversify and protect what you've built, Fastfire Capital teaches you how to do that outside of the stock market. For those of you who want to build wealth more quickly and real estate your vehicle, Semi-Retired MD and Tycoon teach you how to buy and run your own properties the right way. We'll see you in the next video.